Thank you, Mark, and hello from London. Okay, this is not a commentary I really plan to make, but sometimes a market's actions dictates that a few words must be said and then said again and then said for a third time, such as today. I was away last week, but in a way I'm glad to be speaking this week rather than last week, as we've had another major move in this particular market I've recently commentated upon more than once. It is, of course, Bitcoin again. I can hear you yet again, some of you groaning and some of you are moving closer to the speaker of whatever device you're using. So, over the last few weeks there's been much hype and speculation, excessive speculation if you like, surrounding the stratospheric rise of Bitcoin and also the other cryptocurrencies. I'm not a sensationalist in this. My interest in it is purely from a technical analysis point of view, and my commentaries reflect this. However, every so often it is worth noting the real world effects of what has been happening here. More on that point later. Okay, so going back in time a bit, we had a descending triangle pattern throughout January that morphed into a clear bullish descending wedge pattern towards the end of the month. At the start of February, prices broke higher, easily reaching their targets and then continuing higher until they peaked on Sunday at 58,354. In that process of moving higher, the market allowed a really good bullish Andrews pitchfork to be drawn for the mid-December 2020 to late January 2021 action. That's the three lines going off upwards towards the right of the chart. Why was it really good? Well, this theoretical bullish Andrews pitchfork proved to be empirical. During mid-February, the rising middle time, currently at 55,445, acted as a dynamic rising resistance that capped prices until last Friday, when they shot up and closed over it with a key reversal up. The rise looked like it might be sustained until Monday this week, when we had a big drop down through the middle time. Yet even this did not completely negate the middle time, as the market closed right about on the same time that night after recovering quite a bit from the fall. This recovery was a false move, as the writing was already there in the daily patterns. That Monday was a huge bearish hanging man pattern. Yesterday saw the result of that bearish hanging man pattern, with Tuesday making a large bearish opening black Mariposa. Quite a long one, really. What was interesting in that fall was how low the huge two-day move down yesterday was right on the lower time. The low of that day was right on the lower time, which is currently at 45,294 of that very same big bullish Andrews pitchfork. You could therefore surmise, should you wish, that the very recent move down has emptied out the weak hands in Bitcoin, but still kept in place the underlying bullish angle of attack. So why the fall in a non-technical analysis sense? Well, it seems the whole cryptocurrency market lost more than $200 billion in just 24 hours, allegedly prompted by a panic among retail investors. Bitcoin now has a market value under $1 billion. Ethereum, the second largest crypto coin, reached its lowest level in 3 weeks with an apparent market cap of around $180 billion, down from $230 billion on the 20th of February. The total value of the cryptocurrency market has seemingly dropped from about $1.7 trillion on the weekend to about $1.5 trillion now. Some of the latest data suggests some $4 billion worth of long positions were liquidated in a single 24-hour period. The nearest similar crash this happened in early January, when the whole market lost some $170 billion within a single day. Overall, volatility has obviously increased in recent months due to high demand not only from retail but also from institutional investors. However, limited supply and what looks like a liquidity crisis risks remain in these markets. It was recently pointed out in a JP Morgan research note that liquidity has especially deteriorated in the past few months, allegedly due to big whales in the market moving their large holdings off digital exchanges and into their own crypto wallets, leading to the float of crypto assets at exchanges dropping to the lowest level for more than 2 years. Why do I mention all this? Well, if you just saw some $200 billion suddenly disappear in any market, you would look carefully, very carefully, to see if there were any knock-on effects in other markets. For more detailed analysis of this and other products, please contact me through the usual channels, and I can send you a copy of my heavily notated charts. And with that, I conclude the broadcast from London. Hope you found these comments useful.